Okay, listen, I'm going to compress 10 years of fundamental trading into the next 30 minutes or so. And I know how that sounds. Every guy on YouTube says something like that and then they just don't deliver anything. But hear me out for a second, because by the end of this video, it's going to change. I'm going to show you 10 pillars, the shift in perspective that the pros use that no one actually talks about. And this is not going to be just more information piled on top of the information you already have. It's going to be the filter, it's going to be the knowledge, the pillar knowledge, the thing that actually finally makes all the stuff that you already know make a little bit more sense. So stick with me, let's get into it. Pillar number one. And this is the one, okay? It's the first one for a reason. Write it down. Markets don't care about what happened. They care about what's next. Here's what this means. Let's say the Federal Reserve cuts rates by 25 basis points. Everyone expected a 25 basis point. Okay, this is the important part. Everyone expected a 25 basis point cut. So what just happened here? Pretty much nothing. The market moved a little bit, but nothing that could actually be traded. Okay, nothing high conviction that could be traded. Nothing surprised the market. And if you try to trade this, you were trading pretty much here. Okay, you were trading nothing. This is what most retail traders actually miss. They wait for the news because after all, the interest rate decision is marked as a high impact event in Forex factoring, whatever. So they look at that and they think it's a big deal in any case, whatever they do. And so they wait for the news, they look at the raw number, they learn that, rate cuts are bearish and rate hikes bullish. So they see a 25 basis point cut and they jump into shorts for the dollar. But it actually doesn't do anything. Now, the big pillar that I want you to understand the difference between reacting, jumping into that, and actually understanding what's going on is this. The macro funds, ones that actually move size and know what you're doing, they build their positions weeks in advance, okay? When the hints were being dropped leading into the rate cut, okay? Every central bank leaves certain hints in advance of what they're going to do. That's called forward guidance. Now, the point is, most of the time, the move happens heading into the event and not after. You heard the saying, buy the rumor, sell the news. That's literally what it is. The market is a forward-looking machine. It's not pricing yesterday, it's pricing what it thinks is coming out a week ahead, even a month ahead. So leading up to the interest rate decision, what the market does, it sells the dollar. It sells the dollar. Why? Because the hints were there. Powell said, inflation moving sustainable toward targets. The case for easing will strengthen. Easing means rate cuts. Recent data suggests this inflation trend remains intact. We can cut rates. So the hints were being dropped in the right places at the right time, leading into the 25 basis point cut. And so what happened? During the 25 basis point cut, nothing pretty much happened. But before that, the trend was the one that could be traded. The point is, unless an event is generally completely unexpected, the second he hits the screen, often it's pretty much already old news, and you have to start looking ahead for what's next, not for just what happened, but for what's next. Now, put this one in your pocket, write it down, and let's move to the next pillar. Because the question now is, if the event itself doesn't really drive the trend in the moment it happens, then what it does? What moves the trend? What creates the trend? Well, that's pillar number two. Pillar number two is understanding that the data is input for monetary policy. Inflation, labor market, growth, these are inputs. They are ingredients going into a machine, and that machine is the central bank's decision, okay? Follow me here closely because this is very important. Why does inflation matter? Because if it runs too hot or stays too low for too long, the central bank is forced to react and move interest rates, and that moves the currency. Why does the labor market happen? Same reason. If it overheats, they hike. If it weakens, they cut. That's the framework to understand data. Let's say the inflation CPI prints, it comes in hot, expected at 2.8, prints 3%, higher than expected. Well, most traders look at this and say, okay, well, this is bullish USD. And that's correct. But you have to frame that in the right framework. The frame of mind to look at the data and interpret the data is to ask, does this change, does this move expectations for what the central bank will do next? So does this push the central banks toward a rate cut, a rate hike, or doing nothing? Because that's what actually moved the currency. Expectation for what the interest rate will do next. Not the CPI itself, but the repricing of what the central bank is now expected to do ahead because of that CPI number. You see the difference here? Very important. Okay, But does that mean you have to actually sit on Forex Factory all day, refreshing the calendar, trying to trade every single print? Well, that's a lot. No, you don't have to do that. And that's pillar number 3. Not all data matters. The economic calendar, Forex Factory, whatever you use, is full of noise. Obviously, they just report everything that happens, but you don't have to look at everything that happens. Generally, most of it doesn't move anything. You don't need to chase every red folder. You don't have to chase every orange folder. What you actually need is the 20% of data that moves the central bank's mandate. And honestly, to make it really, really simple, because I know you like simple things, it's mostly 2 things. Core inflation, so core CPI, core PCE, and the labor market, okay? So CPI, PCE, which is actually the favorite inflation metric for the Federal Reserve, labor market, NFP, the unemployment rate, and so on and so forth. Wages also very important. Wages, which lead actually, relate to inflation. But that's pretty much the framework, okay? Inflation and labor market data. That's what you have to look to understand how the central bank is thinking, how the central bank is looking at the economy, and what they're most likely going to do next. Now, the wrong question is asking whether, the news is high impact or low impact. The right question instead is, obviously, does this change what the central bank will do next? Does this change the narrative? Does this alter what the central bank is expected to do next? If yes, you can pay attention to the number. You can look for a deviation from the expectation. You can look for the surprise. And if no, it's just noise. You can skip it. You can go do something else. It's a simple rule. If the central bank does not care about the piece of data that you're looking at, the market doesn't care about it either, so neither should you. Understood? Perfect. Pillar number 4. And this one is the one that actually trips a lot of people. Fundamentals don't predict with precision. They frame probabilities. See, the point is that fundamentals are not going to tell you whether, the dollar is going to move 15 pips higher or lower on that day, specifically on that specific moment. Anyone trying to sell you that is lying to you. Period. What fundamentals can do is give you the path of least resistance. It's telling you, hey, things are moving in a certain direction fundamentally, so the market should trend in a certain direction fundamentally. The direction the river is flowing, so to speak. So once you know that, what do? You can swim with the current and not against it. Because here's what happens. When you line your technical execution with the macro context, suddenly you see that you can find very decent trades that line up with the trend, with the context, and suddenly your trade start to look a little bit smoother, okay? Because you're trading with the flow and not against it. And that is actually what leads me to pillar number 5, which is the one that most so-called fundamental traders completely miss. There are no fundamentals without technicals. You can be 100% right in the direction fundamentally and still get a stop loss, still get stopped out, because you can be right on direction but wrong on timing, okay? You can see, you react on this comment, this is so bearish, you understand it's actually so bearish, but you enter short here and you get squeezed out here. Again, get squeezed out. This is just an example, but you get the point. If you don't time the entry correctly, you can end up getting squeezed out right before obviously the market proves you right. So how do you fix that? Well, timing. You time your entries with basic technical triggers. You don't chase, but rather you wait for a breakout of corrective structure like this. You wait for, a retest. Whatever you look technically, there's plenty of strategies, content, and technical knowledge out there that you know very well, I'm sure. So any technical strategy you like, just implement it in the direction of the macro trend, and you'll see your trading improve substantially. And I want you to let me know in the comments if that's true for you or not. The logic is very simple. Fundamentals for direction, technicals for entry. Because let me bring this a step further. This is the part that almost no one actually talks and says out loud. Technicals are conditional. Context is king. A bullish engulfing candle by itself does not move the market. You know that. Funds moving around move the market. And funds move because of macro. So a textbook setup, like a textbook bullish engulfing candle, with the fundamentals saying nothing or pointing the other way, often, not always, but often, is just noise. Or at least it's not just something that you want to follow comfortably. It's not something you want to put your money on, okay? But the same setup, the same engulfing candle, but this time backed by a real macro event, a real catalyst, a central bank comment, Trump saying something, whatever it is. Now you've got something. Now you've got a technical setup backed by a fundamental catalyst. So the point is, next time you see a clean macro setup forming, before you click buy just because, ask yourself one thing. What macro event actually formed this setup? Is there something behind it, or is there nothing? If you can answer that, you're going to be way ahead of 95% of traders out there, okay? Pillar number 6, risk sentiment changes the personalities of currencies, because not every move is created by a central bank. Sometimes the entire market just flips completely on a switch because of geopolitics, because of risk sentiment. And when that happens, everything you thought you knew about a currency can go out the window. Meaning, risk on means traders and investors are most risk tolerant and they're willing to buy risk assets and high beta currencies. Risk off means everyone rush for the exit from those high beta currencies and those risk assets, and they buy safe havens. Now the point is, when fear hits, in this case you're looking at an example very recent where obviously a military campaign was started against Iran, and that's a great example because when fear hits, when uncertainty hits, monetary policy goes out the window. Now in this case, the Reserve Bank of Australia for the Australian dollar was very hawkish in this context. They were just hiking rates, they were going to hike rates even further, but that doesn't matter if an event like this happens that shifts the cards on the table and shifts the sentiment towards a certain direction, is in this case risk off. So it doesn't matter what, in this case, the Reserve Bank of Australia said a week ago. The market dumps the high beta currency, in this case the Australian dollar, but that's also the New Zealand dollar, the British pound, the Canadian dollar as well, and runs straight into the safe havens, the dollar, the Swiss franc, the Japanese yen. Now that's the dynamic you have to understand if you actually want to trade macro. It's not just monetary policy, it's not just central banks, it's also the risk sentiment. So you've seen an example of a risk-off event right here, hitting an Australian dollar, which is a high beta currency, against the dollar, which is a safe haven, and the opposite is true. What happens when that fear lifts, when that uncertainty lifts? Well, the opposite happens. These currencies rise and safe havens fall. In this case, you're actually seeing obviously the ceasefire announcement from Trump and obviously the Australian dollar rallying against the dollar, doing exactly the opposite of what it did before. Okay, that's the dynamic. Risk off, risk on. So before you do all your monetary policy analysis, always keep in mind if the market is risk off because of whatever and whatever, and if the market is risk on because of whatever and whatever. Okay, context is king. Pillar number 7. At any given moment, the market has a dominant story. One main thing it cares about. Now, you've just seen a geopolitical story. That's an example. Sometimes it's monetary policy between two central banks. Sometimes it's tariffs. Sometimes, as you've seen, geopolitics. Sometimes a recession. It can be anything. Your task is not to memorize every single macro variable that exists. Your task is to figure out at any given moment in time what the market actually cares about right now. The dominant macro story right now. Everything else is pretty much background noise. Okay, it can become background noise. And if you don't know what the dominant story is at any given moment in time, in any given trend, you just step aside and wait until you get some clarity. Okay, and this ties perfectly with point number 8. This is the most important one. Once you know the narrative, you have to answer one question with clarity. Okay, just one simple question. Continuation or exhaustion? And you hear me out because I want you to understand me very well on this. We're not asking if technically the trend is overbought or oversold and whatever. We're asking if the story itself that has started this move, that is moving price right now, has more room to expand further, to continue. So in this case, the geopolitical example we just saw, is the ceasefire going to hold and whatever. Okay, just follow me here. If the story that is driving the trend has reason to continue, you can ride the trend. If the story is exhausting, if there's going to be a pivot soon in the story, from, let's say, a geopolitical escalation to a ceasefire, well, the narrative changes, so you can fade the trend. You can fade the move that actually went on from the geopolitical risk off, because things are going to move into geopolitical risk on, okay? So you either look for a continuation of the macro story, or you look for a pivot in the macro story. And we're talking about the macro story, okay? The fundamental story that is driving the trend. Not talking about the technical pivot, not talking about anything else. We're talking about the story, the thing that has started to move price from here. What is going to happen next from here? Is it going to continue? That thing that happened, the moved price, is it going to continue, or is it going to pivot? You've seen it with the geopolitical risk off to risk on in the Iran context. So memorize this question before you take any trade whatsoever. Okay, you have to understand what's next ahead. Now, pillar number 9. Understand all scenarios and evaluate frame probabilities and risks. Now, the pros don't sit here and say, every USD is going to 120 no matter what. That's not what they do. They say something like, if the European Central Bank, pushes back on rate cuts at the next meeting, then the Euro USD is likely to reach 120. But if they decide to signal cuts instead, then the opposite will happen, and Euro USD will reach 116. So scenario A, scenario B. Scenario B is a risk to scenario A is a risk to scenario B. What I mean is that you're not trying to be right at all costs. You're trying to be prepared, evaluating scenarios and risks. Choose scenarios, choose different probabilities, because you can assess that based on the recent data, scenario A has an 80% chance of playing out, and scenario B has a 20% chance of playing out. You're assessing the risk reward here. You're assessing the probabilities for your trade. And if it goes wrong, you actually know why it went wrong. Okay? So you know what would invalidate the trade. Pillar 10, the one that ties all of this together. Fundamentals are not a vocabulary test. Okay? They're not just textbook definitions. It's not memorizing what GDP is. It's not just knowing what risk on or risk off means by definition. It's deeper than that. It's reading the story the market is telling. What does it care about right now? Where is it leaning? What should make it flip? The narrative. What's the narrative? What could flip the narrative? If you can answer those 3 things, you're going to be ahead a lot. Now, before I let you go now, one warning. Because if I don't say this, you're going to go out, get stopped out on your first trade and go back to looking for the perfect combo of technical indicators. Remember, I've said that again, but I'm going to say it once more time. Direction is not timing, okay? Direction is not timing. You can be right on the macro story. You can know that things are most likely going to move in a certain direction because fundamentally this and this. But if you ignore the execution, if you ignore the technical timing, you can be stopped out right before being proved right. I'm repeating this because it's really important. Macro tells you which way, price action tells you when. If you skip one, you're not doing it the best way. And second, this I have not mentioned, but I need to mention very importantly, narratives, the story driving the trend at a certain point can be different from a week from now, a month from now, okay? So don't over-attach to a bias. Don't get stuck in an old narrative. The market does not care about your subjective view. That's the most important thing you can understand. If things shift, like in this case, Powell going from rate cuts to they're not going to need to cut rates any further. If things shift, don't get stuck in the old narrative, make the pivot. Perfect. Now let me bring this together for you. 5 things that you can actually walk away with. Number 1, market's price, what's next? Most of the time, the news is already old by the time you see it. Number 2, every data point is just an input. The one question that only matters is, does this change for the central bank? Does this change something for the central bank? If yes, it matters. If no, it's noise. 3, fundamentals for direction, technicals for timing. I've repeated this enough. Never one without the other. And 4, identify the dominant narrative and then ask, is it likely to continue? If so, you got a trade. If not, you got another trade. And 5, do not get attached to a view. That is it. That's the whole thing. 10 years of macro fundamentals experience compressed into one video. If even one of those landed for you, drop a comment below and tell me which one you liked most. I'll read every single comment. And if this video changed how you look at the market by even just a tiny 1%, that makes a difference hit the like button below as the signal that pushes it out to more traders who need to hear this.